Hello, everyone. Thank you for joining us on a lovely Saturday morning, joining us on your weekend. So, today we are going to speak about gold to gold standard. Gold has always been a safe haven, but the sudden volatility in gold is making everyone confused. To address this, we have with us Mr. Jia Balaji sir, who has been an industry veteran and has been in the industry for the past 2 decades. Over to you, Jia sir.
Thanks, Komal. Thanks for everyone joining. A very good morning on a lovely Saturday morning on 1st of November. Before starting into the presentation, maybe a quick disclaimer. The whole idea about this is more of an educational purpose and it should not be construed for any investment decision, right? So with the disclaimer apart, I think the one of the most important question coming up as an investor today is, should we look into gold? There is so much of momentum, every news channel, every newspaper covering about gold. But I think the most important question which we should think is, what is next gold, right? Because last few years, gold has done phenomenally well. So that's where I think this topic came up called gold to gold standard, where if we have already have exposure to gold, which most of us in some form of jewelry, some form of ETF, how do we think about today? What led this price action, which I'll touch upon in the subsequent slides? Then what happened to the gold mining companies globally, like Barrick Gold, Newmont? How did they perform? And gold funds, which only invest into gold mining companies, right? They've done phenomenally well. But if we have exposure both to gold and gold mining funds, I think today is a very good time to think about where are we in the cycle, how to look forward, right? So that's the whole intent about this. Maybe next 30, 35 minutes, I'll quickly cover on this ground and we'll open the floor for questions. We'll be happy to answer, right? So the first thing is, how did the gold perform? So this is a very interesting data. 1 second, I'll just put the pointer. It becomes easy. If you look at the data, right, it's a 55-year data in terms of year-wise how gold has performed. And what we have done is we have actually bifurcated into two pieces. One, a period of abnormal high return, which is close to 1970, 1980. We had an excessively high return phase. Then for a 20-year period, a period of poor return where the gold underperformed terribly all asset class. Then again, a period of 2002, 2011 is a period where gold did extremely well. Again, a large underperformance for close to a decade. And now last 3 to 4 years, gold did extremely well. Okay, so if you look at 1970, 80 was a high inflationary period. If you look at 2001, 2010 also, right? Very synchronized growth, slightly high inflation period. Oil went to $140. So this did extremely well. But if you look at, interestingly, the current rally, right? Inflation is not abnormal. Obviously, post Russia-Ukraine war and the seizing of assets, we clearly saw the background was very positive for gold. And last 3 to 4 years, gold did phenomenally well. So I think this is what the starting point, right? How gold has performed. Now, if you have to look at how gold has performed vis-a-vis the broad Indian markets, right? To give you one idea, on the left, you can see Nifty 50 has done extremely well for the last 10 years, last 10, 11 years. But if you look at the same Nifty 50 divided by gold terms instead of INR terms, is actually at a 10-year low, reflecting for last 10-year period, it's very interesting to see the most productive asset like the well-run companies has actually equivalently performed gold, right? So the rally in the last 3, 4 years has really caught up to such an extent where a productive asset and obviously a currency type of an asset, which is gold, is now close to the same levels, right? So having seen the 50 years performance and how it has performed over the Nifty also, now let us get into what has driven this rally, right? The first and foremost is the in any commodity as an allocator of capital, right? We need to watch the supply side economics. Very interesting trend you can observe during 2010 and 2018. The production of the gold was moved from close to $2,700 to $3,500 pounds, right? In terms of tons. But after that, if you look at, right, the production is stabilized, right, between 3,500, right? It's clearly reflecting the last 60 years between 2018 2024, production did not caught up. So in this circumstances where when the demand came, which I will subsequently will share, you saw a sudden spike in the gold price. Having seen the supply side, right now, historically, if you have to look at the gold price, so there are three effective variable, which is I would say the most important, right? There are many other variable, but I think the three most effective variable which as an investor we should keep in mind is one is US real yield, US inflation, and eventually US dollar valuation. Real yield is just basically a function of interest minus the inflation, right? Which gives you what is the effective yield you're getting, and which is also called an opportunity cost. Whenever the yield is lower or in negative, gold tend to do very well, which is also in sync with US inflation, right? Whenever inflation is very high, to hedge this macro shock, right, investors tend to go into gold, and this both real yield and the inflation will finally determine into USD valuation. If you look at subsequently what are the major drivers of USD valuation, the first one is the current account deficit. And if you look at current account deficit, right, post 1980, before 1980, US had good periods of current account surplus. But I think post 1980, they had a very consistent current account deficit except 1 or 2 years. And it's been only significantly rising, right? So there were a dot-com bust, then there was a 2008 crash, and everything led to a consistent current account deficit. And on the right, you can see a very interesting chart where US cumulative current account deficit is equivalent to the basically 15 largest economies current account surplus, primarily driven by Japan. Saving pool has gone into the US. That is why whenever USD moves, right, it has a significant impact over the world. The second important interesting variable is the real rates, right? Whenever real rates goes down, you typically end up seeing the gold price going up, right? So if you look at the Fed cut policy, which is also going to aid. So in the last few months back, when the Fed cut the policy, right? Clearly, if you can see the gold which stabilized between 3,200 to $3,400 actually galloped to 4,000 and eventually peaked close to 4,300. And then obviously, subsequently, we saw a fall close to $4,000. So these are the fundamental reason, but I think there are far more fundamental reason as playing out the rally between $2,000 to $4,000. The first incremental factor is the central bank buying. Interestingly, central bank used to buy in a very methodological manner, very stable manner, but post the Russia invasion and right, and then change in policy and the macro uncertainty, clearly you see a big shift in the trend. Central bank is one of the largest buyer of gold, and they actually up the ante, right, in the order of 3.6 times. This is one of the key variable led to this sudden movement in the last 2 to 3 years. And if you have to look at the what this has cost, right? If you look at the reserve, gold reserve as a part of FX currency for most of the country today is close to all-time high, right? China today within the forex reserve close to 7% is gold. Japan is also close to 6 to 7%, right? Everything is trending up. So the key question is, can this 7 can become 10, or this is already at all-time high? At some point in time, if central bankers were to decide enough is enough, let us pause it, which is what getting reflected in YTD, right? If you look at YTD accumulation of gold, this year is much, much lesser than the last year YTD accumulation of gold by the central bankers. Slight change in policy is already seen. And I think this is what, as an investor, we need to watch out, right? Because central bankers are the one of the primary driver of incremental buying, and they are actually slowing down in the last 9 months. The second incremental factor, which has really, really galloped, this data is a few months old. I think World Gold Council just published the quarter end data, and 134% rise in ETF flow, right? Clearly reflecting finally the retail and the HNI money is catching up with the mega trend. And you can clearly see, right, gold holdings in the ETF is going up and the flow is also going up. So this is a second incremental variable post central banker. The third variable, I think, which we are very, very aware is the uncertainty factor. The uncertainty factor has been generally trending up, but post COVID, I think it trended significantly higher. Then we stabilized, and then post, obviously, right, a new government in US, right, clearly reflecting the policy uncertainty today very high. So we have already peaked to a greater extent, and there is a bit of a fall. So the assumption today, if you are holding gold, is Is the uncertainty level is going to go down or is going to go up is one of the very critical variable, and that will determine in the short term how gold will behave, right? But already the last 2 years, the uncertainty level has gone up. It means for us to believe far more uncertainty is going to come, I think there is a bigger problem is waiting. At least we wish and we hope, right? Uncertainty will settle down, and that can turn out to be very, very negative for gold because gold is today already taken into this uncertainty and priced it from $2,000 to $4,000. So to sum it up, the sum total of factors, right? Very interesting slide. Data is put out by Dead Bank, the source from them only. So this is basically last 26 years data on the what caused the gold price to rise, right? So at the initial period, if you have to look at DXY, which is basically USD currency and the US real yield, which was the biggest driver of gold value. But if you look at on the right, slowly this has become smaller and smaller. And the biggest variable today is the policy uncertainty and political uncertainty, which is what today people are buying in. So one of the view which we should take if you have gold as an investment is how does the political and policy uncertainty will evolve? It's going to be far more worse, then obviously it's going to be a little more positive to gold. But if you think we already hit a place where a good amount of rally has happened because of this nature, and if this is going to subside, right, that can turn out to be a headwind. I think this is what in the last, what to say, 2 3 years rally has cost, right, in terms of the gold. So, what are the potential risks as we see for the gold price, if at all, right, where to correct? And I think October was a good month to see it topped and fell sharply. Gold fell, and gold mining companies fell close to 20%, right, within few weeks, clearly reflecting at higher levels. People are a little more uncertain about the price. So, to put in one perspective, the first risk which we clearly see is the mammoth supply overhang. So the risk point, there are a couple of risks which we clearly see. The first risk is the supply overhang. Clearly, the stock is close to 2.16 lakh tons of gold is already there in the form of jewelry, bar and coins, and the central bank. And if you look at jewelry, right, clearly 20% on the volume terms. And interesting within that, volumes are down close to 45%, reflecting the jewelry organizations are actually drawing down on the inventory, which is clearly a bearish sign. The bars and coins is part of an investment, and the central bankers are already owning close to 40,000 tons of this gold. The second news is on the good news can lead to liquidation, right? Because of last 3 to 4 years uncertainty, clearly gold has been one of the favored asset. Everybody is liking it. But any good development on the trade policy between US and China, US and India, and maybe a war ending in a few amicable deals, right? Suddenly the world will look a little better. And an asset which cannot produce cash, right, will be least looked upon. And I think that could trigger a round of, in terms of liquidation, which we should keep in mind. And the third one, as I told, lower jewelry buying. Already we are clearly seeing whenever the price action is significantly rise, the unit volume demand is going down. And since jewelry demand is one of the large demand, right, any the incremental slowdown will put pressure, right, in terms of if the demand is constant and the supply is going to come up or demand is going to go down, which is going to put pressure on the gold price. So, having seen the historical trend of the gold, cost the gold to move from $2,000 to $4,000. Now, let's see how gold mining companies are performed in the same period, and maybe then finally, how is our perspective on both gold and gold mining companies. So to bring one thing in order, we thought we will take three large gold mining companies out of the world. One is Newmont, Agnico Eagle, and Barrick. They are between $50 billion to $100 billion type of a company, pretty large, which clearly reflects by tracking them, right? It gives you a good clarity on the World Mining Fund and a broader trend in terms of how they choose project and at what assumptions they carry, right? So Barrick is doing one of the large capex today, keeping $2,500 per ounce as a gold, right? So clearly they're not penciling in a 3,000 or a 4,000 for the project. So they're thinking at $2,500, we are good to get into the project, and already few projects are taken off, which clearly means in the medium term, supply is going to come from Barrick, Newmont, and every other company. So one of the thing very interesting data from Metal Focus as one of the organizations shared is on the how is the production by companies and how is the cost curve, right? So production is pretty stable for last 2 years by most of the company. As I told, Newmont is largest, Barrick is second large, and then followed by other companies. But if you look at on the right, this is a very interesting chart called all-in sustaining cost. So the bars are the cost and the orange line is the gold. So if you have to look at generally the gold price track the cost curve, when the cost curve went up, the gold went up. And when cost curve was slightly gone down, gold also came down, right? So this is a very interesting phase to allocate capital. But what happened now, if you see the it's only the cost is close to $1,600, but I think gold has already crossed to 4,000, right? This is a quarter old data. So with $1,600 and the 4,000, clearly this gap has opened up. This is what I say, right? The fundamental today production cost for to produce a gold is between $1,600 to $1,700 based on which project, which country. And obviously, producing gold is not an easy thing. A typical production growth is close to 2% only. But what it clearly brings in, there is a clear incentive for today for Barrick, Newmont to look for new projects because at gold at 4,000, right, with $1,600, clearly the incentive is there for them to look for the projects and bring supply maybe in the medium term. So this is one variable which we should keep in mind when gold at what price it can settle down, right? If at all there is a fall. The second thing is where does typically these companies spend money, right? So very interestingly, 50% of the cost for the mining company goes to labor, a very intense labor intensive business. The 30 is material and consumable, and finally 15 is of the fuel and energy. And if you have to look at the margins, right? So with gold at 3,200, this data is still 3,200. Obviously, when this data gets updated, significant margin expansion would have been seen in the charts. If you have to look at margin is already close to all-time high. This is at $3,200. At 4,000, the margin is significantly high. And interestingly, capital expenditure to depreciation ratio, what it means is if I have to look at this period, the companies invested a lot more than depreciation. Basically, they were trying to expand the production. Then they did not spend money. Basically, they want to have had a period where as much depreciation is what they invested. So the intent is not to produce more gold. So that is what caused the bull run. But now, if you can see the last 3 years or 4 years, slowly this trend is moving up, reflecting again the majors like Newmont, Barrick, and everybody started investing into the projects, which is what, right? So there is a period where they did not invest, and now there is a period where they started investing. Obviously, it will take time for the production to commence, but I think already the journey is on to bring more supply of gold into the world. So with gold rising, you have seen significant margin, high cash flow, right? Significant cash flow improvement to the gold mining company. If you have to look at the period of between 2010 to 16, 17, the cash flow was very erratic. You had a very good years, very bad years, good year, bad, and then significant spike from 20, slight weekend, again significant spike. So I think the period between 2025, significant cash flow is being created. What happens when a corporate generates a lot of cash flow? There are two material use you see, right? One, they pay off the debt. Second, they get into projects. That is what precisely happening. Here you clearly saw the projects are going up. That is where the capital expenditure is picking up. Second, the debt has crashed close to zero. Most of the gold company today are debt free. So it is very rare, right, to see a very high capital intensive company becoming debt free, reflecting the significant profit pool which they are generating. So a dream scenario has happened for investor who invested into gold mining company, basically because production is stable, rising end price, the gold has moved from $2,000 to $4,000, which led to huge profitability and cash flow, the best of balance sheet. And eventually, when this four happens, right, we have seen both in equities in India and globally, right? Re-rating is one of the variable will happen because you are buying into a company which is pristine, which can invest into the future and can pay dividend, can buy back shares, right? A phenomenal setup for any investor who invested in the past. Because when this transition happens is where you make a lot of money. Post this transition, you will make okay money, right? So the proof of the pudding, obviously, right? With this all, gold mining company like Barrick, Newmont, Anglo all did extremely well, close to 80-90% in the last 1 year, significant rise. And if you have to look at globally, two major trends happened, right? One, AI related stocks did extremely well. Second, gold related mining companies did extremely well, right? So this was one of the most successful investment thesis of the last 1 to 2 years. So what this rally has cost is this rally has cost the cheapness has gone away. So if you have to look at one variable which is dividend yield before the rally was close to 4%. Today it's close to 2%. So it's down by 50%, right? So the margin of safety 2 to 3 years back was far significant than today because the valuations have really caught up, and which is also the same data getting reflected in price to NAV. So many mining company is always looked up as price to NAV. And I think we have seen one peak in 2010, another peak in 20, and then it went down, and now we are close to that, right? And this is again a few months back data. So obviously we have hit the peak and slightly turned, reflecting the last 2 to 3 years rally has really risen the valuation, and that is what we need to ask what we should do at this point in time. So how did the gold mining companies fund perform, right? So there is one fund in India which is DSP World Gold Fund. So what we have done from our own house, right? This is our internal data. We have just put the 1 year rolling return of this fund. So I'll explain you what is 1 year is. In the last 10 years, so what is 1 year return at any point in time is what we have plotted. So this fund in between 2016, right, gave 100% to 120% return, right? This is 1 year return, and then quickly the 1 year return moved to negative. So reflecting, this fund tend to perform in big swings. So you had a 1 year return of more than 100. Another period where 1920, the 1 year return was close to 70, 80. Then again a negative return. Again, now if you see the 1 year return was close to 100, right? So what it gives you is this fund tend to perform in spurts, and once it goes to this 100 to 150, right? Typically in the past, it has retraced sharply from the performance, right? So I think this is a very interesting time to think about how do, if at all we have made gains, we are part of this fund, right? What is our thought process at this point in time is a very important question to ask, and then think about it. The second very interesting way of we look at this data is called our vantage point of DSP World Gold Fund. And I'll give you how to look at this data. Again, a little tricky one, but I'll make it a little more simpler. So this is 2008 investor 1 year return was minus 11%. 2009 year investor, right? So first Jan somebody invested, his 1 year return was close to 27. So if you have to look at this, this is all 1 year return. And if you have to look at 1 year return variation, there were periods where investors have made minus 36% within 1 year after they invested. And there are periods like now, in the last 1 year, the investor have made 100%, right? So this fund has given all type of experience, and actually it has behaved like a stock because obviously the variable is only one variable, gold price and the cost and the amount of production. So I think it is behaving like a stock and it's clearly coming out. But what is interesting is somebody invested 16, 17 years, right? The entire compounded value of this fund is close to 7%. So, what it clearly brings out over a long period, the fund has delivered 7, but a period like 2023, 24, and 25, you had a cumulative return of more than 150%, reflecting the bounty happens in short period, and that is where we clearly believe there are few funds where buy and hold doesn't apply. And I think we need to clearly think about when a fund is so volatile, how do we make money first? Having made the money, how do we protect money? That's the next important question. The last thing which I want to share it is on the depth of water, basically the drawdown. For anybody invested in this fund at any point in time, what was the drawdown? The maximum drawdown the funds I've seen is close to 40%. In 2010, 2021, it has fallen 50%, right? Reflecting this fund tend to be very volatile and now currently close to all-time high, reflecting again, right? Drawdowns tells you one, the long-term return sometimes in some of the funds will be very good. But I think in between, as an investor, we need to prepare the depth of water, how much why it went up. We have seen the sorry, it's come up again. Fine, yeah, okay, right. On the on the much the fund can fall from the peak. So if you have to look at historically in the last 10 years, we have seen a period where between 2016 to 18, the fund fell close to 50% and then recovered. Again, between 2020 to 2022, the fund fell close to 48% and then recovered, right? So clearly reflecting, even though you're a long-term investor, we should be very, very mindful how much the volatility we can observe. And this fund tend to be far more volatile than a typical fund out of India or the globally. So, having seen the gold price, having seen how the gold mining companies' performance on the fundamental, and obviously on the price action and the valuation, the last question which is there in everyone's mind and hopefully right is, if I'm owning gold, what are we thinking about? So, before getting into the thinking, I just want to introduce our capital allocation framework from FPS Assets, which will give you a good idea about how to think about it and how we think about it. We clearly see every client account, right, when we look up, right? So there are three set of ideas there part of the portfolio. There are ideas which are sunrise, basically forward looking. The next 2 to 3 or 4 year window is extremely good in terms of money making. And there are sun neutral ideas, basically where already momentum is there. Ideas not very expensive, earnings growth is coming, reasonable momentum is there, chugging very well, but a potential exit idea this side. And finally, we also see sunset ideas where idea of the past, which has done extremely well, peaking and maybe started moving to a lower zone, which is where the inefficiency creeps in. So I think we always keep looking at every portfolio with this sunrise, sun neutral, and sunset type of framework. And if we think, right, within our limited purview, we clearly see 2023 was a sunrise for the gold in terms of where clearly the took off happened from the $2,000 to close to $4,000. The mid of 25, I think the momentum caught up. And how we think about momentum is the initial buyers were jewelry and the central bankers. And now the bigger buyer is coming from ETF and the investment demand. As I told, investment demand for the last quarter grew upward of 100%, reflecting clearly from a permanent buyer or a long buyer to a momentum buyer has come in. Obviously, this rally can continue, but we clearly see somewhere it has hit the place of a sun neutral phase, we believe strongly. And I don't think we have gone to a stage or a sunset, but I think clearly, right, it's in the later part of sun neutral, and we need to be very, very mindful at this point in time. So the question today is not to ask, can we allocate more capital? If you already have exposure, I think enjoy the benefit and obviously, right, whenever it is appropriate to consider right action. So what are the potential area, right, if we have to reallocate this type of a capital, right, having made good money in terms of a gold is one of the area we clearly see is the high quality funds or the extremely well because of capex led growth. But I think last so we clearly see high quality market, reasonable valuation. I will not say they are very cheap. I think in Indian markets doesn't look like anything looks very cheap. But I think relative terms, I think they are far more acceptable than maybe a cyclical led companies with a low cash conversion types, right? So that is one area, potential area we clearly see can do reasonably well in the medium term. The second area we clearly see can benefit out of growth coming back in India, both real and nominal. If you have to look at our credit growth has moved from 15-16% to close to 10% and now slightly moved between 10 to 11. We clearly see the growth coming back on India should help the credit growth moving from 10 to 15 and margin stabilizing and credit cost stabilizing, right? Which should give a very good environment for one of the largest component of the index, which is banking or banking related ATMs, right? So these are the two broad, what to say, in our view, a positive area to allocate capital. To summarize, buy and hold philosophy is good, but it doesn't apply for all assets at every point in time. We need to look at asset dispassionately and see, does this asset, can I hold it for a long period? And can I hold the volatility? If no, I think we need to reconsider. The second thing, the risk to reward in our view is turning slightly unfavorable given the sharp run up in the last few years. So which clearly, right, the best, the easy money we always say in investing was actually between 2023, maybe 25. Now I think it could be a very heavy lifting because, as I told, the cost of production is close to $1,600 to $1,700, and gold were to rise from $4,000 to maybe let's say $8,000. I think we have another significant problem where to come in, right? Because gold, in a way, is a currency, and that reflects something really, really structural problem. So this is our limited view on the where we think gold is. Moderate your exposure. If you're over allocated, speak to your advisor or consultant and take appropriate action. Finally, right, always right. And as an investor, our job is to keep allocating capital to area where currently value is there and there is no positive consensus. I think if we can do every now and then in terms of allocating money from a consensus trade to a non-consensus trade, keeping a 3 to 4 year outlook, I think our portfolio is always positioned to compound capital. So our primary job is to not to get swayed by the near-term momentum, because after the momentum passes away, right, what we will be end up having is overexposed to an asset, right, and that can hurt all of us. I think with that, I would like to thank you for your valuable time. Maybe a quick run up of our offerings to give you an idea. So we are a 4 month old firm. We have the license for distribution license for mutual fund, PMS, AIF, and these are a couple of offerings, right, from equity mutual fund, fixed deposit, ETF, REITs, and some thematic mutual funds also, and PMS, right? A quick disclaimer: all data information used in the preparation of the material is dated, and we should be careful. The statement made in the presentation are forward looking, based on our current view and assumption, and involve known and unknown uncertainty that may cause actual results or events to be materially different from the expressed herewith. So, thanks for your time, and we'll be opening the floor for question. Thanks for your time. Thank you.